It's interesting. I happen to know for a fact that Miley Cyrus is a huge Fast Money fan, and one of her hits is, in fact, The Climb, which is a beautiful song. But this is not a good climb. This is not what you want to see. Rates are not going higher for the right reasons, in my opinion. This is now a confluence of events going on globally. We're at levels we haven't seen in quite some time. I think, and I've looked at it, I think we're about to break through a 40-year downtrend in yields. And rates going higher in this environment, to me, is going to be very negative for equities. You're right. The stock market sort of hung in there, sold off late. We're at levels in the S&P that we topped out at in August of last year, this sort of 43.50 level. This should be support. But if yields continue to move like they're moving, there's going to be some ramifications for global equity markets.
I think they top out next week. I think we see into Jackson Hole. I think everyone's got on one side of this trade here, and everyone's convinced that we're going to break out of this range that we've been in now in the 10-year, for the last, call it 6 months or so. I have to give Savita Subramanian. She was on the desk for the whole hour. Remember that in late June? And she just, got up in my grill and said, no, rates are going higher. I think they were at like 3.75 or something like that in the 10-year, and that was a really good call. But going back to just kind of sentiment and the way everyone's positioned, it just seems like that this is a foregone conclusion. What do we know about markets and being on this desk and making these hot takes all the time? We know that when something seems like a foregone conclusion, it usually goes the other way. And so I don't know. I just kind of want to think about taking the other side of this. I did have a bullish position in the TLT. I started it a few weeks ago. That did not go well. That was in my face here a little bit, but I think the timing, I was just a little bit early, so I think it could set up pretty decently right now. The last thing I'll just say about equities, because that's what you asked about it, I think it is having an effect on equities. And if you go back and you think about when the market really got their arms around what the Fed was going to do to battle inflation in late 2021, the highest valuation stuff started to sell off. That's kind of what's happening right now over the last few weeks with the S&P down 5%. So I think there's a chance that it could start to snowball a little bit, and this 5% downdraft in the S&P could easily turn into a 10%.
Yeah, it's definitely keeping the pressure on the big cap technology stocks, which already started the month under pressure themselves, Karen.
Right.
I guess I was just surprised the S&P broadly closed with less than a % decline. I would have thought this, very important move higher would have had a little bit more of a toll on sort of the equal weight.
Well, there's some things that everything I own pretty much was down except for anything that was a hedge position. But there's a few things going on. I think one of them is as this idea of maybe no recession, right, a soft landing or no recession at all, sort of gets more traction. There's sort of the idea of, wow, that if bonds were down because of a looming recession, and that's not the case anymore. So now we see bond rates rise. And then, we always talk about it's just math. What's the discount rate when you have a much higher risk-free rate? So, and the higher your multiple is, the more pain to the multiple when it comes down. So there's some of that. I think that today was just an awful day for me, but I think that some of the stuff that is a low PE, I do feel comfortable with. So retail was a little better than I thought. So there are pockets where things are going well. I just think that run up in the NASDAQ was unsustainable.
Yeah, these guys mentioned positioning, Tim, and obviously next week is a very big week for a couple of different reasons. Jerome Powell speaks on the 25th. Yeah. That's going to be key, obviously.
NVIDIA.
We've also got NVIDIA on the 23rd. So these are two sort of different events, and they're going to have a big impact on the markets individually.
Well, let's reference the Miley climb, and if you look at what semis were doing, and I would argue, Apple has taken the Miley climb, even though it's been steep, but it seems like it's kind of taken the elevator down, and we've seen that with a bunch of other stocks. And in terms of semiconductors, NVIDIA's actually outperformed the group on the way down, which are down over 10% now. And if you look at that NVIDIA gap up, it feels like the SMH wants to trade down to 135. In terms of where people are on yields, I think people were not necessarily positioning for higher yields, and that's where equities are now really starting to take a tumble. And if you look back, I know we just quoted we are at 15-year highs on the 10-year. And if you look back even just 2 years, we've moved up 300 basis points in terms of the 10-year. That's your discount rate. What equities, what are they worth with a discount rate that's 300 basis points higher than they were 2 years ago? By the way, when markets were at at least the high multiple stocks were effectively at their all-time highs, and the market was close to making all-time highs. So if you look at the market today, clearly interest rate sensitives are the ones getting whacked. Look at the home builders. Look at the XHB down 3.7%. That one has really turned, and it's turned quickly. Even though that we've had great earnings out of the home builders, we've heard about their ability to kind of fill the financing gap and where the multiples aren't stretched. Look at emerging markets, which looked like they were about to break out and have now really been pasted. And I would say the high multiple tech trade, everything that could be ARC or some portfolio of companies that were trading in multiples that never made sense. They made a lot of sense for most of this year. And those things have turned quickly, too. So I still think that the pain trade is higher on rates. I don't know. I mean, Dan, you may be right on that in terms of positioning. Is everybody pushing for that now? I get the sense that most people were of the view that rates couldn't go higher. And some of these things that have hit the radar screen over the last few days, including China, Fitch, JGB's refunding schedule, these are things that really were not in the calculus.